Joining us now on the markets, Amy Silverman, RBC Capital Markets, head of derivatives strategy. Amy, great to see you this morning. We were just talking about how, broadly speaking, the market has been resilient, but kind of churning as it rotates around and tries to digest a lot of these issues, suppressing, index level volatility. How are investors kind of treating this setup, and how does it play into what you think volatility might become?
Look, I think this year is going to be interesting. We've kind of joked that this is a paddling duck market, right? You get that calm and smooth duck on the surface, but those little feet are violently paddling underneath. And that's kind of the rotation you're seeing, which to some degree suppresses index level volatility. If you think back this week, we didn't actually hit a close to close VIX over 20, which is kind of your psychological barrier. I think that's fascinating because anyone we speak to would probably say they felt like there was more volatility. There certainly was more intraday volatility. But, my one key takeaway is volatility can go a lot higher because if you do get that correlation picking up, things starting to co-move together, in particular with macro news, we certainly have a long way to go. And you can see that, back to 2018 when we had our last trade war.
For sure. 2018 obviously was pretty eventful, but it was preceded by a very long period of time in 2017. We had low volatility. The market was just kind of stair-stepping higher. You had pretty calm on the macro front. I wonder right now if it feels as if this dispersion, the kind of the way different stocks and sectors are moving separately from one another and that kind of offsetting action, if you see that as being an actual strategy. In other words, are there traders or players in the market that are essentially trying to capture that effect as opposed to it just being, the result of investors in individual stocks doing what they're doing?
Yeah, that's a really great question, and that's a really great nuance. So I will say two things. Certainly there is just idiosyncratic and fundamental investors all the time who are doing their stock picking, and certainly there's a lot of kind of different sectors that will have different impacts based on fiscal policy, cabinet picks, et cetera. But to your second point, the short answer is yes, there's actual dispersion strategies in the market between, being short index volatility or necessarily long single stock volatility. But the other thing we're just seeing is there's just rampant volatility harvesting. So meaning people who are just selling volatility to gain extra yield. And that's been a culprit. I will say people like to blame that for some of the index level volatility suppression we've seen. If you just look at the growth of notional volatility ETFs that are shorting volatility, that's certainly possible. I would say, honestly, it's a culmination of all these things. But you get one big pothole that really could flip like a switch. And that's what I think folks are kind of angsty about this year, in particular after two 20% plus S&P years.
Right. And how does the pretty aggressive flow from retail traders in certain parts of this market? I mean, you can observe it in individual stocks. You can observe it in the aggregate options trading data. How does that play into all of this, whether it's people kind of, trying to ride it or maybe play against it?
Yeah. So watching the retail flow has been fascinating because while institutional investors, I would say, to some degree were relatively long, were actually picking up on hedging, you saw a lot of retail buying the dip. It's almost the same mentality we've had since post-COVID to not only buy the dip, but to also be long call options. To some degree in this market, that has been beneficial because it's sort of, you have a long buyer on one side and short volatility on the other. But, the other thing that we're seeing is the tenors that retail investors are going to are also getting shorter, and that's also creating some structural changes in our market. So for instance, going into 0-day to expiry options versus going to tenors that used to be 1 month to 3 months long has really changed the structure of our market.
There's barely a dip to buy. I mean, there was a 5% right. dip for about 5 minutes.
For a hot second, right? And then it went away. Yeah.